Good morning, it's Wednesday, the 4th of October in London. This is the Bloomberg Daybreak Europe podcast. I'm Stephen Carroll.
And I'm Kriti Gupta. Coming up today, the bond sell-off continues as the 30-year US Treasury yield hits 2007 levels.
US Republican Kevin McCarthy is ousted as House Speaker by those in his own party.
Plus, looking for lightning in a bottle, Rishi Sunak seeks to put the Tory agenda back on track as HS2 dominates headlines.
Let's start with a roundup of our top stories.
The US Treasury 30-year yield touching 5% for the first time since 2007. The relentless sell-off in US government bonds is sparking turmoil across global bond markets. The rout accelerated after the latest US data showed job openings increasing by more than expected in August to 9.6 million. Our markets reporter Valerie Teitel says the moves are unprecedented in recent times.
This rout in the Treasury market is just absolutely phenomenal. Honestly, I've never seen anything like it myself. I've been in the markets for nearly 15 years now. This steepening that we're seeing since Jerome Powell's testimony 2 weeks ago, that was 10 sessions ago.
The relentless sell-off mentioned there by Valerie Teitel in U.S. government bonds is also seeing conditions deteriorate in corporate credit. At least two corporate borrowers standing down planned issuances on Tuesday thanks to the market volatility.
The market reaction comes as Atlanta Fed President Raphael Bostic shared his thoughts on the hiking cycle. Speaking at an event in Atlanta, Bostic said the Fed should hold rates at elevated levels.
What I'm grateful to say is that we've seen inflation come down. I feel like we're in restrictive space now, and now that we just need to let that restriction play out and let it bring inflation, continue to bring inflation down to get back into the range of our target. And if we can do that, that would be a good thing.
Bostic's comments come as the US Treasury Secretary Janet Yellen also weighed in on the debate. She told a conference in Washington that while the strength of the US economy suggests rates will remain higher for longer, quote, it's by no means a given.
Kevin McCarthy has been ousted as the House Speaker after Republican hardliners rebelled over his compromise with Democrats to avert a government shutdown. Goldman Sachs says the move raises the risk of a shutdown next month as his eventual successor will be under, quote, even more pressure from those on the right of the party. The move ends a tumultuous 9 months in the job for McCarthy, who says he won't run for the position again.
I don't regret standing up for choosing governance over grievance. It is my responsibility. It is my job. I do not regret negotiating. Our government is designed to find compromise. I don't regret my efforts to build coalitions and find solutions. I was raised to solve problems, not create them.
Despite McCarthy's lack of regret, the latest turmoil has fueled concerns about deepening dysfunction in Washington. The last time the House even voted on removing a speaker was over in 1910, and in that case, the office holder survived the test.
The Prime Minister Rishi Sunak is today expected to announce that part of Europe's biggest infrastructure project, HS2, is being scrapped. It's understood the Prime Minister will use his speech at the Conservative Party conference to soften the blow, announcing that some of the savings will be used to boost other parts of the UK's transport network. But Labour's Greater Manchester Mayor Andy Burnham says the plan is a disgrace.
Do not pull the plug on the north of England. Do not treat people here as second-class citizens when it comes to transport, because if you do those things, people here will never forget.
Burnham's criticism has been echoed by both the former Chancellor George Osborne and Conservative West Midlands Mayor Andy Street. Here's what he told Bloomberg Radio.
My argument is you do need to have HS2, so that's not really the question, is it? And of course what's been put to the Prime Minister is a proposal which is supported by private businesses to say, let us try to rethink the link to the north, but it is still needed to win the investment around the world.
Those comments from Andy Street and others have helped to cast a long shadow over the annual Tory gathering. HS2 was a core plank of the party's previous pledge to level up economic opportunities across the country.
Palantir, the data analysis firm co-founded by tech billionaire Peter Thiel, has emerged as the top pick for a major NHS data contract. The 5-year deal could be worth close to £500 million and focuses on analysing medical information. Palantir's relationship with the NHS has been criticized by civil rights and patient advocacy groups who worry about data privacy and the firm's work with intelligence and defence agencies.
Billionaire investor Ray Dalio says US-China relations are close to breaking down. Speaking to Bloomberg's David Weston at the Bridgewater Associates founder warned of the risk of conflict between the world's two largest economies.
The US-China relationship are in a number of areas on the brink of red lines. So, in other words, these irreconcilable differences, they're right on the brink.
Dalio went on to say that the breaking point would be if the United States comes out in favour of an independent Taiwan. That, he said, would be, quote, the equivalent of a declaration of war. Dalio has long nurtured relations with Chinese officials and has previously expressed admiration for some of Beijing's economic policies. So let's talk more then about the rout in global bond markets. We've been talking this morning about the 30-year Treasury yield hitting that 5% level for the first time since 2007, just slightly below that at the moment, back down around 4.99%. This is a milestone moment for markets at the time that we've seen Treasuries essentially bulldoze their way through global markets to the greatest extent that we saw at the start of the pandemic. Our market supporter Valerie Teitel is with us as well. And this is something I know you've been following closely too. I mean, where to start in this? First of all, Valerie, can we talk about yesterday first and what happened?
Yesterday was a phenomenal session, one of the worst sessions for the Treasury market on the year. Not only did we have the 30-year yield rise 15 basis points on the session, but all across the curve, 5-year, 10-year, and 30-year breached new cycle highs. And it is phenomenal to see this move extending in the Asia session, in the European session, as well as you just mentioned, that 30-year yield breaching 5%. The weakness in the equity market is continuing. S&P was down some 1.4% today. Futures are falling nearly another 0.6 so far this morning. So that's a 2% move in the last two sessions just so far for the S&P 500. And the rout is notable globally. Not only did we see Japan 5-year yields breaching a new decade highs, we also had Germany 10-year yields breaching 3% for the first time since 2011. Honestly, there are too many superlatives out there for how high these yields have gotten in this phenomenal steepening of the Treasury curve that we have seen over the summer and continuing into the fall.
Well, I think the scariest superlative is these are the highest levels in yields going back to 2007, which doesn't exactly instill a lot of confidence in terms of what comes next. Valerie, what is the ripple effect here?
Yet to be seen, Critty. We know that what happened last year here in the UK when we had that such volatility in long-end gilts, it caused pension funds and insurers to really fall out of bed. That one really came out of nowhere. Is there some risk lurking in the US at the moment for those holders of this long-end debt? I mean, some of these 30-year treasuries are trading below 50 cents on the dollar now. That is just an unprecedented amount of losses that we are seeing in the Treasury market, which around the world is known as a safe asset, as a safe haven, as something you hold because it holds its value. That's clearly not been the case in the last 2 years in the Treasury market. But we're seeing gyrations happen elsewhere across emerging markets, a bit jittery when it comes to this dollar strength causing those emerging market currencies to weaken. We saw it in the credit markets yesterday. We're seeing credit spreads start to creep wider and some issuers in the U.S. yesterday pulling their deals just due to this Treasury volatility. We're also seeing it in financial conditions. This is something that could possibly be in the Fed's favor in some way. Financial conditions are now flipped into tightening territory due to the strengthening dollar, due to this rise in yields, and due to these credit spreads beginning to widen.
Chrissy, can we talk a bit about the kind of political implications here as well? Because, of course, higher yields immediately means the cost of borrowing for the US government gets even higher. And part of this story is the supply issue around the fact that the US government is borrowing that much more.
Yeah, it really is. And I think part of this is as well, and this is something that Valerie could probably weigh in on as well, is that when you look at the 30-year yield, that is the yield that a lot of people are taking out mortgages on as well, just on the surface as well. So when you were talking about a crack in the markets, the fact that the long end affects the housing market, well, that's going to affect the broader economy. Can you imagine going into 2024 when people are kind of hitting all of their, or say submitting their ballots, and suddenly their household wealth has completely been eliminated or is even more expensive than initially thought, those mortgage payments getting higher? I think James Carville, the famous political strategist, had said, it's the economy, stupid. That's how you decide who's president. This isn't... I mean,
how you punctuate that is quite important as well.
It really is. But I mean, that it happens to be the sense. And I think that's been the concern around why gasoline prices, for example, are such a political mover. But housing is not far behind.
But this is happening at a time when, even within the US political scene, there's more upheaval because Kevin McCarthy is now gone as Speaker, putting essentially Congress into stasis until they figure that out.
Yeah, I mean, look, it's not the best time in Washington right now. We aren't exactly setting a great precedent, I want to say, in terms of leadership. But I think what you have to keep in mind here is that, look, this shutdown just got a whole lot harder. And I think those are the calls that matter from a political standpoint.
Because we're
overnight.
only, 6 weeks away?
November 17th, yeah, is when the U.S. government shuts down. And look, I think just for some kind of inside baseball here, or inside cricket, as I believe it's called on this side of the ocean, is basically that one of the major issues of the spending bill has been you can't touch defense spending. Mm-hmm. Ukrainian aid has kind of gone out the window, essentially. And then a lot of it is coming down as well as how you tackle eventually what will be the debt load as well. And there are calls coming out of Goldman that are saying because of the politicization of this, you are now going to see it become even harder to actually hit a bipartisan deal come November 17th. The first people that get hit in a shutdown are your servicemen, are your troops. And again, coming from the South, that is a real sticking point for a lot of the folks who are very passionate about our army.
Valerie, sorry, go ahead.
Yeah, and you have to wonder whether the markets are really going to force some political change when it comes to Washington and just how much money they're spending. Because I'll give you some shocking stats. 30% of treasuries have to be refinanced in the next 16 months. And a lot of questions are now being raised as to whether those debt financing costs are going to become too much of a burden to the U.S. government and possibly push the path towards fiscal unsustainability. We had a call out from Goldman yesterday noting that they see interest expense rising to 4% of GDP by 2030. That is a shocking statistic. It has not gone much above 2%. I think the highest it was back in the 1990s where we reached 2%. But if we're really headed for this higher for longer situation in the bond market, the U.S. government could be the first casualty of that.
Yeah.
Valerie, can we talk a bit about the international impact of this as well? Because, I mean, we've seen the German yield curve is uninverted in the past few minutes because we've seen the 30-year yield move above where the 2-year yield is. The 10-year German bond yield over 3% for the first time since 2011. This is a story that is rippling through markets across the world.
It's rippling through, and let's be clear, the central bank in Europe and the central bank here in the UK have really no control over what's going on. This will tighten financial conditions globally as we see yields rise, and that is not something the ECB or the Bank of England can necessarily fight. This is being led by the U.S., and let's be honest, even in the U.S., the Fed really does have no control over long-end yields unless they intend on embarking again on quantitative easing, which is something I don't think they have necessarily on their radar. So this is going to be a very, very hard thing for not just politicians, but for central banks to fight.
The other aspect of this, of course, to think about is where we see the other asset classes, essentially, as I look across the sea of red on my Bloomberg terminal this morning as well. I mean, when we're thinking about what happens next in this story, Valerie, where do we need to watch for what might either accelerate this further or potentially bring some calm to markets? Well,
my mind goes straight to the big data we have on Friday. We get the monthly payroll report out of the U.S., which, if it does reflect a hotter than expected labor market yet again, we could see a bit more panic when it comes to the Treasury market, and that hit equities and strengthen the dollar as well. That could be the next kicker. But, I mean, it could also be the kicker that could end the sell-off, right? If we get a weak payroll print, let's say, way weaker than expected, we could all calm down now thinking that the U.S. economy is going to slow down. Maybe this higher for longer mantra is a bit of a lie, kind of like transitory, and that's on the horizon. So I think Friday's data is going to be pivotal for what happens forward.
Spoken like a true macro thinker. I'll do the micro here because I'll take the other side of it, which is when you look at the ripple effects in terms of this market, take a look at what the stock market has not priced in. The stock market around the world, I might add, has not priced in this higher borrowing cost. We know that the Fed has been hiking. We know that a lot of these has been priced in for 2022. It has not been priced in for the VAR shocks, which essentially means that all the selling momentum that you're seeing at a lot of these trading desks that hasn't been priced into the stock market. Another place we're going to see a disconnect is when oil starts trading in line with the global sentiment at a time, by the way, when over and over again we see these physical supply shortages, and yet the market is trading in line with the stock market or the bond market, or even the stronger dollar is responding to that as opposed to the fundamental kind of tailwinds for that price. And I think that's where you're going to start to see the dislocations really show up.